Two cheap quality stocks to buy in the stock market right now. This is a video that I don't make very often, but I try to combine a quality company with some kind of an attractive valuation, trading below 20 times earnings. I have two of those stocks today. Both of them are quality companies. They have a moat, they have pricing power, but they're also hated in their own way. One of them is trading at their 52-week low. The other one is a much more popular one that you guys keep asking me about. So I'm going to give you an update on them. And if you do enjoy those videos, all I'm asking is please press the like button and let me know what you think in the comments. Now, the first one, which is one of the most hated ones, that it's a popular one, and this is Alphabet or Google. Alphabet is still down around 8% year to date. It's down 11% over the last 6 months. And I always say, whenever you're buying Alphabet, you're not just buying Google search, which seems to be very hated right now. You're also buying YouTube. I mean, YouTube is one of the best business models in the world. They don't even have to make the content. I am making the content. They make money off my back, a massive commission, and they don't have to lift their finger. All I have to do is to maintain the website. It's very light, capital light, high margin, low expenses kind of business. One of the best business models in the world. And TikTok is not going to kill it, and no website is going to kill it. You do get it if you buy Alphabet. You also get the ad business, which is growing. Google Play, you get Google Cloud, you get Waymo, which is the leader so far in autonomous taxis or autonomous vehicles. You get a stake in the quantum computing division. They have a 10% stake in SpaceX, so you get space exposure. They also own a stake in AST SpaceMobile, which I covered. I believe they own 6% of the company or 7% of the company. So you get so much exposure beyond just the Google search that everyone seems to be hating, especially Google Cloud, which has been rapidly growing, not just in terms of revenues, but also in terms of operating income, which has turned profitable in Q1 of 2023, and it has increased from $200 million to $2.2 billion. To me, this is very, very interesting. Now, if I look at the valuation of Google, again, that's just a quick overview, it's trading at 18 times earnings or almost at 19 times. The average is 23.5 times. It trades as high as 34 times earnings. Now you could buy it almost at 18 times earnings. This is dirt cheap for a company like Google. And it's mainly, again, because of the sentiment around Google search. Now, if we want to be honest, and we look at the blue, Google search is still bringing in almost $200 billion in revenues. It's a very large chunk of Google's revenues and Google's operating income. But we have other very promising segments that are also rapidly growing. One of them is YouTube ads, which is my favorite model. It grew from $20 billion 5 years ago to $36 billion. We look at the Google network revenue, which I believe includes the ad business. It went from 23 billion to 30 billion. Not massive growth, but it's growing nicely. We look at the Google subscriptions kind of revenues from 21 billion to $40 billion. It almost doubled over the last 5 years. And most importantly, Google Cloud went from $13 billion to $43 billion. And now you have the cybersecurity companies that they acquired recently and stakes in SpaceX and Waymo and all these kind of things. To me, I'm not really worried about Google search as much as other people are with the company. And I did an analysis before, and that was mainly an analysis from Barron's, which is one of the most trusted websites, and I love reading the Barron article. And I valued Google in pieces. So if Google Cloud was its own division, what would it be worth based on those margins? If YouTube was its own business, what would it be worth per share? And they came up with a total of $260 per share. This is how much everything is worth. Now, what I said is that Google search business is worth, in their eyes, $143, and that's using 17 times EBITDA, which is fair. Now, if we cut it in half, if we cut it from $143 to like $70, we're still getting a total price of $182 per share. Google right now is still trading at $175. So in other words, if you want to split Google apart and you take 50% off the search value, you're still getting more value right now than what you're paying. This is not future value. This is not a 5-year outlook. This is on the current valuation. You're still getting it below, you could say, liquidation value, if you want to call it this way, for a company like Google. So to me, I'm not really as worried as other people about the search business. Yes, it's going to decline. Yes, ChatGPT is going to take over and other kind of AI. And again, if it goes down 50% and other companies grow, it's going to offset it. And Google knows that. That's why Google has been diversifying in so many different avenues now in cybersecurity and many different places. So I'm not really worried about that too much. Now, if I look at the earnings per share growth, it's been all over the place, 40%, expected to be 18% this year. It was 27, 92, 13, 12. I would say on average, Google will most likely grow 17 to 18% over the next 5 years. Now, if they do maintain it, and you're buying it right now around 18 times earnings, you're basically paying 1-time price to earnings growth. This is dirt cheap for a mega cap stock like Google. So no matter how I look at it is in terms of earnings per share growth relative to the multiple, and if I look at it, if I liquidate it or if I split it in different pieces, and I take 50% of search, I'm still getting 182, which is higher than the current price of around 175. So it's really hard to lose money with Google. And I still believe it's one of the best quality stocks in the market that's trading at an attractive price, especially with the market going up so much. Now, the second one, which is a hated one, but a lot of you have asked me for an update, and I believe it's a quality company. I'm going to tell you why I believe it is. And this is Pepsi. Pepsi is still flat over the last 5 years. It's down 12% year to date, 16% over the last 6 months. Most of you know that Pepsi isn't just a beverage company. They have Lay's, they have Doritos, they have Cheetos, they have water brands, they have some kind of Starbucks, I believe, the at-home kind of ready-to-drink kind of drinks, and they have so many different brands and so many different investments. So less than 50%, I believe, is in beverage, and most of it is actually coming from convenience food. Now, the main problem with Pepsi is many people right now, and they have the right to do so, they've been cutting back on soda consumption. Soda consumption has been declining globally, and maybe even some snacks and chips as people are more cautious of their weight, cautious of their health. And this is amazing, and that's a trend that's very hard to reverse, and I believe it shouldn't be reversed. Now, if we look at volume, Pepsi has been suffering negative volumes since 2022. This is when the trend has started. Last quarter, it was 2% decline in volume. The one before that, 1% decline, 2%, 3%, 2%, 4%. Now, whenever a company is declining in volume, this is really not good at all. Most companies, they don't have the pricing power to raise prices to offset volume. But Pepsi does have this pricing power, which is why I believe it's a quality company. It has pricing power. If you guys like it or don't like it, they do have the pricing power, and they have been demonstrating that. Now, last quarter, volumes declined 2%. Pepsi raised prices 3%. The quarter before that, it declined 1%. Pepsi raised 3%. It declined 2%. Pepsi raised 3%. Declined 3%. Pepsi raised 5%. 2%, 5%, 4%, 9%. So Pepsi has demonstrated more than one time for over, I think it's now 15 quarters, that they are able to raise prices to offset, the volume declines. And the question is how sustainable this is. They're only raising it a few pennies, but it does make a difference and it offsets the price. So I believe it's more sustainable than investors believe. I would say it's at least sustainable for another 10 years. Maybe that's too optimistic, but I believe that's sustainable. So I'm not seeing Pepsi, a company that's going to face a decline in revenue or decline in profits anytime soon, because they have the pricing power for them to raise prices and offset any volume declines. Okay. Now, if I look at the forward PE multiple, it has more than priced in the decline in volumes that I told you guys about, which has started in 2022. Before, you could say 2023 or in 2022, Pepsi used to trade at 23 times, 22 times, up to 35 times earnings at times. And the average is 21.7. Now you could buy Pepsi for 16 times earnings. And people couldn't dream of buying Pepsi for 16 times. Back in 2021, 2022, it was considered a quality company and one of the best retirement dividend stocks you could own. Now people don't like it too much, and it's trading at 16 times. So I do believe that the volume declines are gonna sustain themselves. I don't believe they're gonna reverse unless Pepsi makes so many different investments in healthier alternatives and they grow in volume and they offset it. This is actually what they're doing. They acquired I believe a water company very recently and other kind of areas that are actually growing. So I wouldn't be surprised if that happens. But I'm expecting volumes to keep declining 1 to 2%, but I'm also expecting Pepsi to keep raising prices 3 to 4% to offset the volume declines. And I think 16 times earnings is more than fair for a scenario like that for Pepsi. In fact, it could even be the worst case scenario. Okay. Now, if I look at the dividend yield, which is a good dividend, it's around 4% dividend for Pepsi. So you could get paid 4% while you wait. And this dividend is sustainable. You have to look at free cash flow to determine the sustainability of the dividend. Now, you have to know something that in 2024, free cash flow was only 7.1 billion because there was $1.5 billion in changes in net working capital. And that doesn't happen very often. So free cash flow should have been around 8.5, but it was 7.1. Now they're readjusting for the net working capital this year in 2025. So it's going to be around $9.5 billion and it should sustain around 9.5. Now a $9.5 billion free cash flow, the dividend is 7.3 billion. So this is more than a $2 billion difference between the dividend paid out and the free cash flow. So I'm not seeing a dividend cut anytime soon. And if I combine a 4% dividend, almost 4.5% dividend, I combine it with their own guidance of high single digits in earnings per share growth. They grew 9% CAGR over the last 5 years. I'm seeing 7 to 8% for the next 5 years. So 8% earnings per share growth, 4.5% dividend, that's like 12-13% a year. And then on top of that, you get the potential of a multiple expansion if Pepsi was able to reverse the volume declines through acquisitions into growing areas, then the 16 multiple could revert back to 18, 19, 20 times. So I'm seeing a good setup where you get paid 4%, 4.5% while you wait. The company will likely grow 7 to 8% in earnings per share. That's around a 12-13% annual return, in my opinion, on the low end from here. And you have the call option where if they do have a multiple reversion and it goes back to even 18 times, not 21 times, your return could be very, very high. So I see Pepsi and Google being the best kind of quality stocks to buy in this, what I believe is an expensive market. There's not many good opportunities, but I still like those two stocks very much. And that's just my opinion on Google, Alphabet, I should say, or Pepsi. Not financial advice. Hope you enjoyed it. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.